question, you can either try to type it to me or maybe type it to Suraj. And then we can determine if we want to do questions as we go along during the session or if we want to hold questions until the end. Does that sound good, Suraj?
Yeah, perfect.
Okay, great. All right. So I'm going to talk a little bit about investor preparedness at the early stages, probably where most of you are now. We'll go through a few exercises and then we'll do some goal setting at the end, okay? So let's see. Oops. All right. So just a quick agenda. The viral framework, how you can use it. I'll talk for about 20 minutes or so now, and then we'll do that. All right. So what is investor readiness? It's understanding the key points that investors want to know about your business opportunity so they can decide whether or not they're ready. This doesn't mean that investors, even if they're not ready to invest in you now, they might be ready in 6 months or you might be ready in 6 months. So a few things to keep in mind. We hear about pre-seed angel and pre-seed investment, Series A, Series B, Series C. One part of being ready for an investor is getting to know that investor before you need that investment or you want that investment. So making sure that you're building relationships early, making sure that you are doing your research to find out, if I meet with this person, what am I going to present to them? Where do I want to be in 6 months or in 1 year so that I can be ready for, a Series A or a Series B. So investors are very much about relationships. It's a very personal, a very local business. And so understanding, what's important to that investor, what his or her investment thesis is, what is the mission of the venture capital firm or the grant-making organization, and how does your venture fill in with them? So just as all of you have stories and missions, investors also have missions, and they have a reason why they're motivated to invest in companies, especially early stage companies. So part of, I think, investor readiness that is sometimes we don't talk about as much is really understanding how your mission aligns with that of the VC firm or the angel investor, and being able to tell a story about how you can help each other. So I think that's one thing to keep in mind. I think we see the key points, and your unit economics are very important. Some of the milestones, the measurable, quantifiable milestones are very important. But it's also important to understand how you can build that relationship. I think you'll hear, in Silicon Valley, companies go out and they, it takes 6 to 12 months to close an investment round. In some cases, if you're operating in a frontier market, you could be looking at 18 to 24 months between investment rounds. So also keep that in mind. So that goes back to, the relationship building, as well as kind of the nuts and bolts of actually closing around. All right, so the viral framework. So all of that is sort of messy and confusing. So Ross Baird, who is the president of Village Capital, created a framework to try to streamline that process. So the goal of the framework is to be a bridge between what you as an entrepreneur are presenting to an investor and how the investor is evaluating your venture, your team, some of your partners, and looking at how you can achieve milestones together. So a few things to keep in mind about the viral framework. It's based on Village Capital's experience. Is everyone familiar with Village Capital? Should I just talk a little bit about what they do? That'd be helpful. So Village Capital started several years ago, and the idea was to bring investment capital into underfunded areas. And so they operate in rural areas of the United States. They operate all over the world. They have chapters throughout Latin America, Asia, and Africa. And the idea is to bring cohorts of entrepreneurs together. They go through a series of skill building workshops over several months. And then at various intervals, they vote on who gets funding rounds. And so you're working with your peers, and then you also decide amongst yourselves as a group who receives funding. So the idea is that it's a very democratic way of dispersing funding. And it really gets at the things that investors don't always know. So if you're having a half an hour meeting with an investor to make a decision, you can very much control that conversation. If your peers who work with you day in and day out are also looking at, who should have the funding. So Ross said, well, I think it's more democratic to have the people who are actually working in the local ecosystem and the people who understand how these entrepreneurs are thinking, how they're operating, to actually determine who should receive the funding. So it's a pretty interesting model. It's grown quite a bit in the last couple of years. And so as part of that, they gathered all kinds of data on milestones, on how companies grow, what the pathway to scale and to exit can be. And so he created this viral framework. So again, it's a guide. It's for helping you understand how funders are evaluating your founding team and venture, and at what stage different types of funding may be appropriate. Because the other piece of this is making sure that you're asking for the right ticket size. You don't want to have so little capital that you can't grow. You don't want to have so much capital that the expectations of the funders and your expectations are mismatched. So it's just a little bit, Ross Barrett is also a Kauffman Fellow, so if you want to read more about his work, he has a couple of blogs. You can also Google Ross Barrett and Kauffman Foundation. So this is it. This is the framework. It's a little bit tedious, but it's definitely worth reading through. So I will say that there are some things. This was created about 2 years ago. Ross just published a book about a year ago, and this was part of the book. And so there are a few things that are probably missing over here, especially for companies operating in frontier markets. I would say there are kind of equity crowdfunding is one I've heard that's missing. And then the other is, you don't have to focus on acquisition. There's also, let's say, the pathways to IPO are opening up, and we've seen more evidence of that in the last year. So I think for the purposes of today's session, we'll really just try to focus on levels 1, 2, 3, and 4. And so a lot of you probably right now are maybe around level 3 in some ways. So you're solidifying your value proposition for your clients, your customers, your end users, as well as internal stakeholders in your ecosystem and in your company. Investors care, you'll kind of hear this in different ways, but investors really care about the founding team, and they also really care about traction. So at an early stage, they're really going to look at, who's on your founding team, how did you meet, how long have you been working together. So these are kind of, important things to keep in mind. They want to see that if they're giving, they are making an investment, and they hope that in 12 months time you're going to be saying, okay, we're ready for the next stage, and the next investor is going to return their investment and allow your company to grow. They want to know you have a team that's going to stick together. And so these are some of the things you've probably heard in other sessions. This is where your founders' agreements are important. Your schedule for who earns equity or shares in the company when they can and can't leave. Those are kind of the very important mechanics of that. But they also want to see that you can work well together. So do you have healthy disagreement, healthy distinct points of opinion? And do you have someone who can be the CEO? Do you have someone who can be the COO, the Chief Technology Officer, someone who can run human resources and scale the team as needed? What are you doing internally? What do you have to contract out? I mean, these are all very important things. I've worked with teams in the past that have relied a lot on contractors and consultants, and then they have to think about how do they bring them into the company and for how long, and what do those agreements look like? So when you're talking about establishing the founding team, depending on the industry you're in, or where you are with your product development, those are all important things to think about. If you're dealing with intellectual property, if you're kind of in the hard science, especially healthcare in the Boston area, really understanding who knows how to make your product and what do they know, and can they take that information somewhere else. The next level is setting the vision. And so, do you really have a good sense of your mission, who your customer is, and the kind of challenge they face? And so, at this stage, you could still be pivoting. So, you're thinking, actually, well, at any of these stages, I guess you can pivot. But this stage, it's kind of like, okay, understand, you're starting to form your brand DNA. You're starting to think about, how this problem impacts people. What does that look like in different forms? So you have a, are you starting to articulate who your customer is? So have you broken out all of the different market segments, and are you starting to focus in on a few of those market segments for testing your product or service? And then at level 3, solidifying the value proposition. So hopefully, at that point, you've done some beta testing, you've built a prototype, you've had a pilot or some kind of launch, and you're starting to think about, we know our customer is, what kind of, let's see, if it's B2B, you kind of know what other businesses you want to operate with. If it's B2C, then you understand more about who your individual customer is, his or her challenges, and how you're going to solve them. You're starting to get some evidence that customers will pay the price. So maybe you've done a paid pilot, or you've done a limited trial, and you're getting feedback. And then at, level 4, you're starting to say, okay, this is the market where we think there's room for growth, where we think we could probably capture a little bit of market share, and where we could grow. At different stages, or at different levels of forming your company, you may be at different points. So if you're at level 2, you may be at a 2 for problem and vision, and you could be at a 1 for your founding team, and you could be at a 3 for your product, right? And some of that is a function of the industry you're in and who's on your team and how long you've been working on this. So, so in some ways this is relative. Ross did build this actually based on NASA's technology. So NASA decided that there were too many relative terms floating around referring to the technologies they were using to develop not just rockets and satellites, but for sending people into space. And they said, well, we need to actually map this out and clarify what we mean by the different levels of technology. And so Ross actually, building upon that work, said, well, we're going to do this for startups. So there's some precision here with some of the numbers. You'll see those mostly around kind of finance and market size. But yeah, so this can vary a lot. I do want to call your attention, if you go to validating an investable market at level 4 and down from this market column, you'll see evidence of a 1 billion plus total addressable market. I think, in the US, it's not hard to get, or in a Western country, it's not hard to get to a $1 billion addressable market. Outside of that, if you're working in Latin America, say, evidence of a $1 billion total addressable market. If you're a startup in Argentina, where the market is much smaller, you have to, from the beginning, kind of have a born global attitude and be saying, okay, yes, we're starting in Argentina. This is where we've validated our market. We know what customers or clients or end users are willing to pay for this product or service. And we're confident that we can go to Brazil, and that's a substantial market. And then we can expand into Colombia, and then we can expand into Mexico. So if if you're starting in one particular geographic location, being able to tell that story of how you can grow and scale into these markets is important. Again, I've seen teams work in sub-Saharan Africa. They'll start in Nairobi or they'll start in Ghana because those are more manageable markets and there are fewer headaches, so to speak. But they know ultimately they want to grow in Nigeria because that's where there's substantial growth, both now and in the future. And so thinking about how you're going to tell that story for the total addressable market. And then over here on the right is sort of the type of funding typically closed at this level. And as I said, this is built on Ross's work with village capital teams. And so looking at friends and family, bootstrapping is probably the most common. Getting grants for R&D. I have a brief slide on types of grants later, but you know, kind of getting that you know, free money, if you will, that you don't have to give back for your experimentation, for building things. And then angel and seed funding kind of comes in with friends and family. In some areas, angel and seed funding is kind of its own layer. So again, that will depend on your industry. But this is, again, just a helpful schematic. All right. Are there any questions, Suraj, at this point?
No, sounds good to me. Everyone else okay? Keep going.
All right, great. Okay. This is another very helpful, because most of you are probably focused or will be focused on a seed round. So Parul Singh, who is a venture investor at the Founder Collective here in Cambridge, came up with this. It's in a blog and it's cited later in the slides, but kind of looking at, you hear the term seed and what does that mean? So this kind of takes that intermediate level that's in the viral framework and breaks it down. And so, you know, pre-seed, pre-product launch, so you've done a very early trial or test. You're thinking about how much revenue you might be earning and what your round size is. And so, you know, the seed, you know, seed plus, and then going into Series A. So these are some good benchmarks just to help you think about what investors are looking for relative to the revenue you're generating. Notice it's not necessarily profit, so you don't need to worry about being profitable yet, but just thinking about the revenue that you're generating. So again, there are, you know, here, you know, there are accelerators, there are foundations that are dedicated to this, seed funds, accelerators, and angels. There are specific seed funds now, and then Series A. Angels can actually, they're a little bit tricky. They can come in anywhere. So just for context, an angel is someone who is an accredited investor, which means they have a certain amount of independent wealth, and they can afford to write checks to teams and individuals whom they believe in. And if they, you know, if you succeed, that's fantastic. An angel may often then invest in you at a subsequent stage. They may be happy to have their money returned to them with, you know, with a multiple, and they may say, okay, great, now I can go and invest in another early stage startup. You know, and if you're unable, you know, for whatever reason, things don't work out and you can't return that, it's okay. And the angel will say, great, we tried, but, you know, maybe next time it'll work out. So angels are essentially very wealthy individuals who can afford to take these risks. And they tend to hang out in Boston. I would say there are lots of angels at conferences. So if you have an opportunity to go to a conference or something that's related to your location or your industry, angels may be there. There are also specific groups. There are the Boston Harbor Angels and a few others that hold open pitch sessions, and you can go and meet them and present your ideas. I just have a couple more slides, and I can share these after so you can read through them. So some of the actual kind of nuts and bolts of investments at the early stage, some terms you should probably be familiar with if you aren't already, are convertible notes, simple agreements for future equity. Simple agreements for future equity are still probably more common on the West Coast than they are here on the East Coast, but they're starting to gain some ground. And then recoverable grants. So if any of you have looked at, for example, the Echoing Green Fellowship Foundation, you'll notice that they've moved to a recoverable grant model. So if you're selected as an Echoing Green Fellow, you get that $40,000 for 2 years. If your company ultimately succeeds, at some point they may say, hey, you know, remember when we gave you that $40,000 to get started? You know, we'd actually like to recover that money. So these are just some terms to keep in mind. There are lots of venture capital blogs out there. There are a lot, you know, Up Council and several others have additional resources so you can familiarize yourself with these terms. Investor meetings. So at an early stage, these are some things that investors may or may not ask you. So they'll say, which other investors have you met with? Don't tell them. because they may very well, after you leave, get on the phone with those investors, and they may want to invest in you, but they may get together and actually come up with deal terms that are more favorable to them than to you. This doesn't always happen, and I don't want you to think that all investors are nefarious, but it can happen. So that's one question you get, and you probably will at some point. Just say, we're talking with we're talking with a handful of people who are interested in the work we do. And they may talk to each other anyways, but you can at least help yourself out by not giving out names or names of firms. They'll ask you about your team. They'll care a lot about that. And they'll kind of say, what else should I know? What else should we know? And there may be things like, well, you had a third co-founder and you had verbally agreed that that person would have some equity, and then, something happened. He or she hasn't been coming to meetings for the last several months. They haven't been active, but maybe they had a really key role in that early founding, or they're part of the intellectual property that's so important. So these are things that you don't necessarily want to hide, because they will come out in the due diligence. And there are lots of ways to strategically introduce this information, but these are things to be aware of. We probably don't have time to go over this now, but other questions people have been asked. How can you find out what investors are thinking? Brad Feld, who's a venture capitalist, wrote a book called Venture Deals, which goes into all the nuts and bolts of cap tables, negotiations, and all those things. I would recommend reading it at some point if you haven't already, or just buying a copy to keep as reference for yourself. Bessemer Venture Partners has a great blog. They're based here in Boston. Jessica Livingston, one of the co-founders of Y Combinator, has a blog, and then Parul Singh, of course, who we mentioned earlier. There are lots of others out there. Some next steps and resources. Conveners.org is a great accelerator selection tool. They've also looked at other resources available in the ecosystem, law, those other things you might need. The Global Innovation Exchange, it was started by USAID, but they have all kinds of information on grants and funding that are available. The different Techstars accelerators programs that Suraj mentioned earlier. Visa has a great accelerator for people in the financial inclusion space. There's the RISE Fund, which I believe is affiliated with Steve Case. GSMA, if you're doing mobile and IT solutions, and the Shavas Venture Competition. Okay, so we did that. Okay, Suraj, do you want to do the exercise where they maybe set some goals using viral, or do you want to go into OKRs?
I think it'd be helpful if they can just place themselves at their current level and just have a goal for the next 3 months as to what's the next level that they'd like to get at, and so what needs to happen.
Okay.
Does that sound good?
Sure. And then you can go into OKRs. Okay.
So go on, continue, Judith.
Okay, so I guess you all probably heard Suraj, but I think as we set up for the OKR session, he's going to lead in just a moment. Why don't we take about a minute or so, and you all can think about where you would place yourselves now on the viral framework, and then where you would want to be in 3 to 6 months. Okay? We'll go back to this.